Hello, this is Mike Swanson of WallStreetWindow.com. I'm speaking with a very special guest. I'm talking with Ike Iossif, who runs the website MarketViews.tv. How you doing today, Ike?
I'm doing good, Mike. Thank you. How about yourself?
Oh, I'm doing great. And it's been a couple months since we have done an interview and spoken together and recorded it about the financial markets. And you put together a special two-part series to help us get an overview of what your indicators are showing now and give us a feel for what we might be able to expect in the various financial markets going into the end of the year. And I've got the presentation you sent me, putting it into a YouTube video so people can see it as I'm going through it with you. But it starts off going back to what you were looking back on April the 7th.
Yeah, well, we did two interviews in which we discussed upside targets. One was on April 7th. The other was on May 26th when we discussed my mid-year report. At the moment, we'll focus on the April 7th interview, and then when we do part two, I get back to our mid-year report.
Okay.
Actually, they both are in agreement, in sync, so to speak. Now, back in April, what I had indicated is that if we were to get a decline, then the probability was that we'll get another leg to the upside. That could last until May or October of 2007. And it would take the S&P somewhere between 2470 and 2570. Now, the projections that I come up with are based on regression analysis. So based on what we had at the time, this is the target that we were getting, 2470, 2570 between May and October. Given where we are right now, the regression analysis is giving us a potential upside target between 2650 and 2670 if we were to get above 2570. And that upside target could be realized within the next 90 days. What is interesting also is the probability that goes with this upside target.
Okay, what do you see is the odds of that happening? Because it would be good news for
the probability analysis is telling us right now that the upside target of 2650, 2670 over the 90 days without an intervening decline in excess of 3% is actually 11.22%.
Okay.
Okay, so here's the target. Here's the probability. The market has done many things the last year or so that were low probability outcomes, and yet they happen. So, could we get 2650, 2670 over the next 90 days without the market flinching? Well, I'm telling you, the probability is 11.22.
Well, if someone's fully invested in the stock market, what are the odds of a total crash between now and the end of the year that's a total wipeout and the market falls 50% or something? Like, if the probability is only 11%, then it'll go up that much. Is there a big risk of, people losing a massive amount of money and almost going, a huge crash?
Well, when we did our last interview in July, if you recall, one thing that I said was that statistically speaking, crashes are very low probability events, and therefore they cannot be, predicted, and actually you can't bet the farm on it. However, from a intermediate term point of view, I will say this. Let's say that the market does have an upside potential of 10%. So from 2,500, we can go up to 2,750, 2,800. All right? The downside potential, based on the measures that I look at, is anywhere from wherever the top is anywhere between 55 to 65%. And I will go on record to say this: from wherever the top is, we will get a decline that could be up to 65%. Okay, so if you have a 10% upside potential versus a 50 or 60% decline, that means you're risking $6 to make one. It just does not make any sense from a intermediate to longer, point of view. So,
but right now, though, it doesn't. There's no real warning signs of an imminent decline.
No,
it's more the upside. It's more.
Oh, the running.
Right.
No, okay, and as I said, we're getting new upside targets in the 2650 to 2670 area. Okay. The question is, if you're an intermediate to longer term investor, at what point do you begin to protect your gains? My personal view, which is the same thing that I had said back on May 26th, when again I had talked about an upside target between 25.50 and 25.70, and I had said if we get there, then that would be a good, point to start taking profits and preserving your capital.
Well, this has been a very unusual couple of years, particularly since last August. The market volatility has vanished, and various indicators that would warn of weakness to come in the stock market. Some of the internals indicators that sometimes faltered a little bit, but then they came back. We've had these super low VIX readings and put to call ratio readings and so forth, and no big collapses have happened, and that makes me wonder, or other people wonder, I should say, do technical indicators even work anymore in this market? Is the Fed in control to prevent the market from even declining 1% on any given day?
Well, that's the next area that I would like to address, because I get questions like that all the time. And we have had the same behavior about many indicators. I have just picked out the put-to-call ratio. That's courtesy of decisionpoint.com, stockcharts.com, the Decision Point blog, I should say, to be more accurate. And what the chart shows is the S&P 100 along the CBOE put-to-call ratio, the 10-day moving average, the equity put-to-call ratio, and the OEX put-to-call ratio. Now, you will see that until August of 2016, the same readings produced a respectable decline. After August of 2016, and actually beginning with January of 2017, and I have circled these arrows, we will see that the same readings have produced either a pause or a very small, almost negligible decline. What does that mean, or why that happens? Now, you can use other, indicators with regards to oversold, overbought condition. You will get the same thing. You can use other indicators that have to do with investor sentiment. You will get the same thing. What I want to point out, which people who understand technical analysis know, is this: a technical indicator can identify a point of inflection, but by itself cannot measure the magnitude of the impending move. And you can see this very clearly in the chart that I am posting as an example. You have the very same readings that prior to August 16 produced sizable declines. After August 16, and especially after January 2017, they have produced sideways to almost negligible decline. The question is why? Well, a decline the magnitude of a decline has to do with the intensity of the selling. The magnitude of an advance has to do with the intensity of buying. What has happened since the election is that the prospect of a lower tax rate has resulted in people expecting a huge rally after the tax rate reduction is enacted. So every Tom, Dick, and Harry here is getting positioned for that upcoming rally. So there is no selling. Individual investors are not willing to sell because why sell now when you can sell later at a lower capital tax gains rate? Makes sense, right?
Yeah.
If you are an institutional investor, can you afford to sell and be left behind if the market rallies? That means you can lose your job. So there is no incentive, as long as to sell, whether you're an institutional investor or individual investor, to sell anticipating that the tax rate reduction will bring about a rally. One problem with this is, with everybody getting positioned for that rally after the tax rate reduction takes place, then who's going to left to buy?
Well, what if?
Because everybody got bought already.
I first heard of these tax cut plans last year after Trump got elected, and then right after the inauguration, they said we're going to come out with the plan, we're going to release it, and then I think it was in May, they did put out like a 3-sheet piece of paper, like almost like something on a napkin drawn up, and that was like anticipated for a while. And then, so nothing really happened. And then they're like, well, something will happen later. And then in September, something similar happened where Trump gave a speech. But there was no real concrete plan yet. There still isn't. Could it just, what would happen if they never came out with a concrete plan and just talked and talked and talked? In one way, that might be good for the stock market.
Well, actually, it would be the best you can hope for. As long as there is hope that something will happen on the tax front, then the market perhaps can continue on going higher. I think the reality will sink in when we finally do get the tax rate reduction, and everybody's already in anticipating it. Or there's an announcement that it's dead.
Yeah. Well,
the market is going up on hope, and my view is that hope, as long as it stays alive, can keep the market alive.
Well,
it's as simple as that.
One thing about what you're talking about with the indicators is that around July, I was thinking we could get a market pullback. A real pullback. This fall, because some of the indicators I was looking at and follow were faltering. Some of the internal indicators. And then in August, the market made a little bit of a peak, and it just fell to the 50. The Dow fell to the 50-day moving average. Then it all just went back up again. So I was like, well, that's the pullback. There's like no volatility. And I'm like, no pullbacks coming to there's real volatility again. I'm like, when is that ever going to happen? I mean, it's just I'm trying to follow into what your next chart of the VIX here.
Yeah, before we get to the next one,
okay.
I just want to mention one more thing. My good friend Jim Wells has always said that people do not sell until they believe it is in their own best interest to sell.
Yeah.
And I'm saying this right now again. Individual investors believe that they can sell later with a lower capital gains tax rate. Institutional investors don't want to be left behind and lose their job because the market they sold
right.
And the market left them behind. All right. So at this moment, there is no real motive for either participant group to engage in selling unless something exogenous happens, something that like a black swan event that cannot be predicted based on the evidence we have right now. That's a whole different story. Now, as I said, the question is, how long can investors keep their hopes up about a impending tax rate reduction? That I do not know. But what I am convinced about is that if everybody is getting positioned for the big rally that's going to happen after the tax rate cut takes place, the exact opposite is going to happen because everybody's going to be already positioned. So who's going to buy if already everyone has bought? That's my point.
Yeah. That's something I'm gonna beware of myself. If something passes and Trump starts to sign a bill, we'll see what happens next. But so far right now though, this has been a year of very low VIX readings. I think we've had the lowest, the year, the most number of VIX readings below 10 ever. So it's very interesting.
We're back below the all-time lows of 2007. Now, I have said several times the last 18 months in our interviews that in my experience, what really matters is a negative or a positive divergence on a weekly basis over several months. The chart that we have next, which is the weekly chart for the VIX going back to 2006, we can see that the VIX actually bottomed in early 2007. And although the market declined and went back to marginal new highs, okay, the VIX kept making higher lows, with the May low being the last low before the advance up to 90. Where we are right now, at least that's what the chart says. I'm not saying it, the chart says that, okay? We're back where we were in early 2007. Could we have another 5-6 months of slightly higher prices? Yes, we could. Okay, but my point is, what you need to see is higher lows on a weekly basis for several months in order to have a concrete signal that something has changed. It hasn't changed yet, but we're at the point where it could very well be. And as I said, look at the chart going back 12 years, and it just says it all. Something else that I want to add is the ability of people to trade volatility through VXX or other vehicles has also resulted in a distortion. And one very good example is what happened back in August. We had from August 9th, where the VIX was at 1073, to August 11th, in just 2 days, we went from 1111 on the VIX to a high of 1728. So in just 2 days, we got a 60% advance in the VIX, while at the very same time, okay, the S&P had a decline from 2474 to 2437. Okay, so we had like a 1.8% decline in the S&P and a 60% advance in the VIX. That does not make any sense. I mean, it is totally distorted. Why is this happening? Okay, I just explain why. It's because the daily moves of the VIX are being distorted by the daily trading activities of many investors trying to trade volatility through VXX or other vehicles. So I wouldn't pay that much attention to what goes on from one day to the next, but I will pay attention to what the VIX is saying over a few months on a weekly basis.
Okay.
Okay. Now, the last thing I want to touch upon, and to me it's something very important, which is this. In the US, we have the tendency to think very US centric. In other words, we view what is happening in the US in a vacuum. And something really important happened in Europe the last 30 days. That was the election results in Germany. For the last 8 years, the Christian Democrats, who are the equivalent of our Republicans, had formed a coalition government with the Social Democrats, the equivalent of our Democratic Party. Okay. Now, this grand coalition for the last 8 years came to an end because the Social Democrats got the lowest percentage since 1934. And the Christian Democrats, although won, actually they lost 2 million votes compared to the last election. They lost 1 million votes to the FDP, which is the equivalent to our libertarians, and the AFD, which is the right-wing, the extreme right-wing party. Now, what that means is, this is a reflection of two things. The rise of the AFD has to do with immigration policy. The rise of the FDP has to do with the continuance of low interest rates in Germany. Germans, being traditional savers, have been hurt by the low interest rates, policy of the ECB. So the new coalition government will definitely feature the FDP. One of the conditions the FDP has said before joining the government is that they will place pressure on the ECB to end QE and to end the negative interest rate policy that they have in place. Okay? In Germany, it's going to take between 30 and 90 days before we do have a pact, an agreement, a signed pact, among the parties that will form the new government. So theoretically speaking, over the next 30 to 90 days, the uncertainty over the formation of the new German government and its direction going forward could place pressure on the euro.
Well,
the first chart that we
would
have,
that make the dollar go up?
Well, yeah, but if you look at the chart of the euro, you will see that back in December 2016, a year ago, we had a bear trap. Euro broke below support only to turn around and have a spectacular rally, and then it broke above resistance. I have used a blue rectangle to point the bear trap last year and to point out that perhaps the break above resistance for the euro could be a bull trap. If you look at the US dollar, and the US dollar index is made up of 58% by the euro, is the exact opposite. And you can see that back in December, we had a false breakout, a bull trap, all right, that resulted in 12% decline. And it could very well be that if we see further weakness in the euro, that results in further strength in the dollar by default. The key level to watch is 94. If the dollar gets above 94 or the euro breaks below 117, that could result in a further rally for the dollar for at least for the next 30, maybe 90 days. I think more likely is 30 days, less likely is 90 days. Okay, because I don't see at this point the dollar rallying about 96, maybe 97. Okay. Then if you look at interest rates, my view is the Fed more than likely will be very hesitant to raise rates in 2018. In fact, if it was up to them, they wouldn't even raise rates in December. Okay. However, in the world that is interdependent, European interest rates do affect U.S. interest rates. If we get higher rates, or if investors perceive that QE in Europe is coming to an end, and also we're going to have a more conservative ECB chairman in 2019, and more likely will be a German, and the reason is so far ECB since its inception has had a Dutch chairman, 2 French chairmen, and an Italian, but not a German, despite the fact that Germany is the biggest contributor to the ECB budget. So we're about to get a German government that wants an end to the QE and a German chairman to the ECB. That altogether means a high interest rate for Europe. The market could choose to ignore that. But if we were to get higher interest rates in Europe, more than likely we will see higher interest rates in the US as well. Although the Fed, not because the Fed will raise rates, but investors will sell bonds. What has happened in Europe is this. After dragging out his famous whatever it takes, investors front ran the ECB, knowing that the ECB will buy from them the bonds that they have bought. Okay? So rates went down because of increased buying demand. If right now or the next few months investors foresee that the ECB will change its policy, they are not going to wait until the very last moment to get rid of these bonds they have in their portfolios, because they front run the ECB when the ECB announced their negative rate policy or whatever it takes, and in the same fashion they will front run the bank before the ECB ends QE. So what I'm saying is, it doesn't matter in the end what the ECB wants to do or the Fed wants to do. If investors perceive that we're going to get higher rates in Europe, they will front run the bank, they will sell bonds, and that will raise rates regardless of what the Fed does or the ECB does. And that's a very important point. The good thing, the bullish thing so far is if you look at the weekly chart for the 30-year US Treasury bond, the uptrend from 2014 is holding. That is the good thing. The negative thing is the weekly chart also shows a head and shoulders formation. Head and shoulder patterns come to full conclusion only 60% of the time. Okay? So just because we have this pattern, it doesn't mean we're going to get a breakdown. And again, it should be pointed out that so far the uptrend is holding. But if we were to see the 30-year T-bond breaking below 150 and especially 147.5, that would mean despite the ECB's desire and despite the Fed's desire to keep rates lower, at least in the short term they will go higher, simply because investors are selling. They're selling bonds. Okay? So it could very well be that over the next 30 to 90 days, we get a lower euro, a higher dollar, and higher rates. That could adversely impact gold, which is the last chart that we have. The very good thing about gold, the very bullish thing about gold is that we have two uptrends that are holding and are holding very well. we have the blue channel and the red channel. So even if, let's say, we were to get a further rally in the dollar and gold came down to the lower end of the red channel, it will still be in an uptrend. And my point here is that at this point, any rally in the dollar, I see it as short term, something that could last 30 to 90 days, more likely 30 instead of 90 days. And the chart, unless we were to get a break below 1200, it looks very bullish for gold. Maybe not immediately, and I do want to point out once again that the developments in Europe could place pressure on the euro, and that would place upwards pressure on the US dollar, okay, which will affect gold. But even if that was to happen, at this point, gold still looks bullish, and I would see any decline between 1250 and 1200 as a buying opportunity. So the bottom line of all this, and we're going to have many charts and many details the next time we speak, is that we could see pressure for gold, but it still looks bullish. And regression analysis suggests that if the S&P could climb above 2570, then we can see further upside pressure.
Well, I'm just looking at some of the news that's come out today about the tax cuts, and now the talk is it'll be in December, possibly January, February, before anything is passed. That's coming from Ted Cruz and Mnuchin, the Treasury Secretary. So that would seem to suggest that we now have more time to and going into the end of the year is perfect timing, right? Going into the end of the year, January is perfect timing to look forward to for an end of the year rally or whatever. So, but that's then. We'll return in a couple of days. We're planning on doing this at the end of this week and getting deeper into some of the charts and indicators, and we're just really starting.
Well, Mike, thank you so much.
Well, thank you for taking the time to talk with me, and we got more to talk about next week because there's all kinds of things going on here, and gold is, right now it's the one I'm the most interested in. I mean, I look at this chart of gold, and that 1350 level was resistance here last year, 2014, 2013. So if we can get through that, it's going to really do something. So that's kind of, I'm not saying it's going to happen next week or before we talk again, but, it could dip first easily. But so I'm curious to see more details on everything. And thanks for taking the time to talk with me and everyone else.
Thank you, Mike.